Money management is often mistaken for a technical skill, something reserved for accountants, analysts, or people who genuinely enjoy spreadsheets. But in reality, it is one of the most human skills in business, because every decision you make eventually becomes a financial decision. A business can survive mediocre marketing for a while. It can recover from a weak product launch, and it can even endure a few bad hires. But poor money management has a way of quietly eroding everything from the inside, until one day the numbers force a reality that emotions can no longer deny. Imagine two entrepreneurs launching similar businesses at the same time. One has a remarkable product, polished branding, and enthusiastic customers. The other has something less impressive, perhaps even ordinary by comparison. Yet 12 months later, it is often the second business that remains standing, not because the product was better, but because the owner understood something fundamental. Revenue is not wealth, and sales are not survival. Cash, timing, and financial discipline determine whether a business can continue operating long enough to improve everything else. At its core, money management is not complicated, though it does demand consistency. There are four numbers every business owner must understand deeply: income, expenses, profit, and cash flow. Income is what enters the business. Expenses are what leaves it. Profit is what remains after costs are paid. Cash flow, however, is where many businesses either thrive or collapse, because profit on paper does not guarantee cash in the bank. A company can technically be profitable while simultaneously being unable to pay rent next week, which is the sort of irony accountants understand all too well. Psychologically, humans are not naturally equipped to manage abstract numbers over long periods. We are wired for immediate rewards, visible progress, and emotional decisions. A large payment arriving in your account feels like success, even if half of it belongs to suppliers, the government, or future obligations. This is why so many new business owners confuse temporary inflows with permanent gains. They spend too early, expand too quickly, and celebrate money that was never truly theirs to begin with. The mathematics of business are remarkably unforgiving. If your company earns $10,000 in a month and expenses total $8,500, your profit is $1,500. Simple enough. But if clients pay late and only $4,000 actually arrives this month, your cash position tells a very different story. Rent, salaries, software subscriptions, inventory, taxes, and insurance do not care about your projected earnings. They operate on real dates, not optimistic assumptions. Cash flow is not merely an accounting term. It is the oxygen supply of your enterprise. This is why tracking every dollar matters. Not some dollars, not the large transactions only, every single one. Small leaks sink large ships, and businesses are often far less waterproof than their owners assume. The daily coffee purchased on the company card, the forgotten software subscription, the repeated minor expenses that seem insignificant in isolation, these form patterns. Patterns become habits. Habits become financial outcomes. Fortunately, modern technology has made this easier than ever. Sophisticated accounting platforms can categorize transactions automatically, generate reports instantly, and provide dashboards that would have impressed corporate executives a generation ago. Yet even a simple spreadsheet can be transformational, because the tool itself is less important than the behavior it creates. Awareness changes decisions. Decisions change outcomes. Taxes and insurance deserve particular attention because they are among the least exciting topics and therefore among the most frequently ignored. Unfortunately, reality does not offer discounts for boredom. Taxes accumulate quietly, and insurance only becomes interesting after something expensive happens. Businesses that neglect these areas often learn about them in the most educationally traumatic ways possible. As your business grows, financial management evolves from simple record-keeping into strategic thinking. You begin asking more sophisticated questions. Which products generate the highest margins? Which clients pay reliably? Which expenses genuinely create growth? and which merely create the comforting illusion of progress. Good financial management is not about restriction. It is about clarity. It allows you to deploy resources intentionally rather than emotionally. There is also an identity shift involved. Amateur entrepreneurs often see money as a scorecard, a symbol of personal worth or validation. Professional entrepreneurs see money as inventory, a resource to be allocated carefully. The first approach creates emotional volatility. The second creates resilience. One spends according to feelings. The other allocates according to systems. Ultimately, business success is rarely destroyed by a single catastrophic event. More often, it is weakened by dozens of small financial decisions made without visibility, discipline, or understanding. Money management is everything because it touches everything. Marketing, hiring, expansion, product development, customer service, they all depend on the health of the underlying numbers. Start simple. Track every penny that enters and leaves your business. Review it regularly. Learn what the numbers are trying to tell you. You do not need to become an accountant, but you do need to become financially literate. Because in business, creativity may start the engine, ambition may choose the destination, but money management determines whether the vehicle reaches the end of the road at all. If this story moved you, subscribe and share it with someone who needs to hear it today.